Good evening, everyone. Myself, C. Raj Chawla, Chairman, Union Directorate. Welcome you all in this today series of our webinar on this tax audit. So today we are going to discuss the professional way how to conduct our tax audit. And we are very honored that we have with us CA Chandrasekhar Chitreji, Vice Chairman of TAQRB and ex-Chairman Direct Tax Committee. He has compiled guidance note on tax audit last year after a gap of 8 years. My tax guru also. I also welcome our today's faculty, young and dynamic faculties, CA Pankaj ji and CA Parul Agarwal ji. I also welcome CA Rashi Tagra ji, our moderator for today's program. So friends, I welcome you all and my best wishes that today we are going to learn the new techniques, the new professional way how to handle this tax audit. Thank you.
Well, thank you, Rajbhai. Yeah. Friends, from the month of June, under leadership of Chairman CA Dr. Raj Chawla, we are organizing various webcasts on different topics in tax audit. As all of you are aware, that more than 50% of our professionals are engaged in doing tax audit, particularly if it is class B or class other cities, then maybe 100% or 90% professionals are engaged. So it is necessary that they are equipped with appropriate techniques to conduct this tax audit. I am sure that if you want to report payments exceeding 10,000 under 48.3, and if there are 1 lakh payment vouchers, then maybe you can go through each voucher and you will be able to report. But then maybe you will not be able to complete one tax audit till 30th of September, which is the due date. But then you apply professional technique, maybe apps, maybe something else, as the speakers are going to dilate and discuss with you today. You would be able to finish that job in few minutes, if not in few hours. So these are the ways and means in which we want to equip the professionals to conduct tax audit that would help them not only to report in an appropriate manner within four corners of law, but also to adopt such approaches, such techniques that will save their time. And you know, for chartered accountants, saving of time is equivalent to saving of money. So if you are able to do, say, 20 audits by saving of time, if you are able to do 30 audits, maybe you are earning more and without exposure to any risk. So friends, as far as this conduct of tax audit is concerned, as informed earlier, the Tax Audit Quality Review Board has already come out with a quick referencer to tax audit. And we believe that this is one companion which will quickly enable you to address the issue on hand, because whatever underlying sections are there, we have reproduced. The audit program we have reproduced. Some guidance we have given. Representation letters, appointment letters we have talked about. So this quick reference will practically guide you to conduct the tax audit. Of course, on a theoretical plank, you have guidance note on tax audit, which the Direct Tax Committee, with few changes from last year's guidance note, have now released. So you will also be able to go through that tax audit guidance note, and you will be able to accomplish the tax audit in an appropriate manner within the time allowed. Of course, don't forget to take representation letters also, because that plays pivotal role in the matters which are more litigious. And today we have with us dynamic chartered accountants, Pankaj and Payal. They will be guiding us about this professional approach on tax audit, and taking us through this particular session would be Rashi. So you definitely be well equipped after you attend this particular session. So thank you for joining, and I welcome the faculty, both Payal and Pankaj, and the young chartered accountant Rashi, to coordinate this particular session. Thank you. Over to you, Rashi.
Thank you so much, Chairman Sir and Vice Chairman Sir of Taxation Audit Quality Review Board ICI, for creating this platform and providing us the opportunity to share and express our view. Thank you so much, sir, once again. So good evening, everyone. I hope you all are doing well My name is Rashi Tagra, and I'm honored to be your moderator for today's webinar. I am a practicing chartered accountant, and it's been 14 years to me that I am the member of this esteemed organization, the Institute of Chartered Accountants of India. So today I'm here to ensure that our session runs smoothly and that we take the most of our time together. If you have any questions or need assistance throughout this webinar, please don't hesitate to ask in the chat section or end in question or answer session. I'll do my best to assist you. So let's dive in right and make this webinar a valuable and engaging experience for all of us. Thank you for joining us, everyone. So ladies and gentlemen, esteemed chartered accountants and distinguished guests, I'm delighted to welcome you all to this insightful webinar on the critical subject of tax audit. In today's ever-evolving financial landscape, tax compliances and tax procedures, which are becoming increasingly complex and vital for both business and individuals. As a chartered accountant, we play a very important role in ensuring fiscal transparency and adherence to the tax regulations. This webinar aims to empower us with the latest update, best practices, and expert insight to navigate intricate world of tax audit successfully. Our distinguished panel of speakers will share their extensive knowledge and practical experience to equip us with the tools necessary to excel in the field of tax audit. We encourage active participation and discussion throughout the session as we collectively strive to enhance our understanding to this essential aspect of financial governance. I'm confident that this webinar will prove to be a valuable resource, fostering professional growth and aiding in better services to our clients. Let us embark on this learning journey together as we delve into the nuances of tax audit. Thank you for joining us today, and I look forward for an engaging and enriching discussion today. So, ladies and gentlemen, it is my great pleasure to introduce our distinguished speaker for today's webinar, Mrs. Parul Agarwal, with over 18 years of experience as a practicing chartered accountant. Her impressive journey in the world of taxation and finance includes important role at prestigious Big Four firms such as E&Y and PwC. Throughout her career, Mrs. Agarwal has been a guiding light for both domestic and multinational corporations, providing invaluable expertise in areas ranging from tax-efficient cross-border structuring to India entry and exit strategies. She is renowned for her proficiency in transfer pricing compliances, advisory services, PE-related concerns, and skillfully representing clients before tax authorities. Furthermore, Mrs. Agarwal's commitment to knowledge sharing extends beyond her professional achievements. She is a prolific author, regularly contributing insightful articles to various journals, blogs, and research papers on international taxation issues. Additionally, she has been a esteemed member of the faculty for the International Taxation Diploma course since 2014, also making significant contribution in the course material. We are honored to have Mrs. Agarwal as one of our speakers today, and we eagerly anticipate the wealth of knowledge and expertise she will bring to this webinar. So please join me in giving her a warm welcome. Welcome, ma'am.
Thank you. Thank you so much, Rashi. Thank you, Raj sir. Thank you, Anita ji. And thank you to the entire tech team and, the entire team of ICI for organizing this webinar for the overall good of all the professionals. So just before we start the session today, would just like to also introduce Mr. Pankaj Saraogi. So actually, overall, both of us are contemporaries because there's not much of gap in our, passing the CA exams. And so it was indeed a very good introduction. Thank you so much for this. But today our starting session would be taken by Pankaj ji. And since he'll be discussing the clauses which are really the building pillars of the Form 3CD, as well as which are the building blocks of the Form 3CD, and which are very relevant and should be, discussed in advance before we, understand the broad outline of the entire tax audit report. So by way of introduction, Mr. Pankaj Saraogi is into litigation, tax advisory and compliance. He actually passed out the CA exams in November of 2006. And he's got a very vast experience in direct tax laws. And he's also a rank holder in his CA finals. He's got 10th rank in his CA finals. And he's got highest marks in the direct tax laws. from NIRC of ICAI. And his graduation degree is from SRCC. So this is also quite notable that, he's a SRCC a pass out, and he holds a diploma of international taxation. And he's a special invitee of the Direct Tax Committee of ICAI for financial year 18-19. And he's also a eminent speaker when it comes to workshops and trainings on direct taxation, which are being organized by not only ICAI, but even by other PSUs and some corporates as well. So therefore, I welcome Mr. Pankaj on this excellent platform to deliberate on the clauses relating to Form 3CD. Over to you, Pankaj ji. Thank you so much.
Thank you, ma'am. So, wait a minute, sir. Let me introduce, give a little introduction of you. So, ladies and gentlemen, it is my distinct honor again to introduce our another esteemed speaker for today's session, CA Pankaj Sarogi. With a profound background in litigation, tax advisory and compliances, CA Sarogi has been a pillar of expertise in the realm of direct tax laws. A member of Institute of Chartered Accountants of India since 2007, his dedication to excellence is evident through his remarkable achievements, including securing the 10th rank in CA final and earning the highest mark in direct tax laws. CA Sarogi is a graduate of SRCC and holds a coveted diploma in international taxation. His outstanding contribution to the field have been recognized as he was appointed as a special invitee of Direct Tax Committee of ICAI for the year 2018 and 19. Furthermore, his reputation as an eminent speaker precedes him, having delivered insightful presentation in seminars, workshops, and training sessions on the direct taxes organized by ICAI, PSUs, and corporates alike. We are privileged to have him with us today, and I'm confident that his insight will greatly enrich our webinar. Please join us in extending a warm welcome to CA Pankaj Sarogi. Welcome, sir, and over to you. Now I'll request to start the session. Thank you so much.
Thank you, Rashi. Thank you, Parul. And first of all, I'm highly obliged that I'm having my introduction from two female members of our renowned Institute of Chartered Accountants of India. And obviously, I'm going to tell this particular at my residence also to my wife that I got the introduction from two female members. So, first of all, I would like to a warm good evening to our chairman of Tax Audit Quality Review Board, Raj Chawla sir, and to our vice chairman, Chitale sir, and to the team that are visible on the particular screen, that is Anita ma'am, Rashi ma'am, and the Parul ma'am. So friends, talking about the tax audit, I'm going to share my PPT a little bit later. Friends, if I talk about the journey of the tax audit dream, if I talk about, is like from compilation to, you can talk about the professional approach. If we talk about like up to till assessment year 13-14, I think the main objective of the tax audit was that we have to provide some data in Form 3CD. We have to certify that particular data so that the tax evasions, or you can say tax avoidance, are minimized. That obviously for the assessing officer, it is not possible to check each and every income tax return and along with simultaneously the books of accounts to find out whether the disallowances or allowances as per income tax law or not. And for that purpose, they introduced the concept of the tax audit and we came into the picture. But after assessment year 13-14 and specifically with effect from assessment year 22-23, friends, our responsibility, our certification importance has been increased tremendously. And the best example, if I talk about the certification regarding applicability of the GAR provisions on the transactions entered into by the assessee. Friends, in case of GAR, we all know that the GAR provisions are applicable only if the tax impact is of rupees 3 crore or more. And further, the assessing officer has only authority to give, you can say, the recommendation to a particular panel, which is comprising of very senior officials of the income tax department. And the same thing is getting vetted by us only, certified by us only. That means that the department has some kind of faith, or you can say the responsibility or the skill knowledge they believe we have, that we can certify upon the GAR provisions also. So friends, that gives the, you can say, the extreme feeling of the importance having the, you can say, the degree of the chartered accountancy. But obviously that comes with the, you can say, the accountability also. Obviously, we have to be accountable. We have to be very careful. We have to continuous learning of the provisions of the law, provisions of the requirement of the Form 3CD standards on auditing, so that we can fulfill our responsibility properly. Friends, we all know that through the social media, if we talk about that, we are getting somewhere informations that particular professional has been banned for practice for a particular number of years with fine and by the authority NFRA. As on date, if we talk about NFRA has, you can say the control or the supervision authority regarding the audit of the listed companies. But maybe the government may have in mind that over the due course of time, it may be possible that it may be extended to the audits of the unlisted entities also. But as on date, obviously, it is not there. But we cannot sit relaxed by considering that particular aspect. Friends, I have heard many professional friends that they're saying that in case of audit of unlisted companies, do not take any tension at all because NFRA can't do anything at all. Friends, my simple question is that the NFRA is looking after the audit of the listed companies for the period, you can say that after the period, after the date on which the NFRA has come into the picture. Obviously, no. That authority is looking after the audits of the prior periods also. And obviously, that going to be the case in case that FNRF is given authority in respect of audit of unlisted entities also. So friends, in the first session, we will discuss about the particular clauses which are applicable at large. Obviously, considering the time, in case we have the time little bit later on, we can discuss the other clauses also. But first of all, we will try to focus on the particular clauses which are applicable at large. And secondly, the friends, the tax audit guidance note, which has been released for us on, I think, 4th of September only. That is 4 days back if we talk about. Friends, I have tried to find out some substantial changes in the guidance note 2022 versus 2023 and try to discuss with you in a summarized manner. So let's start with that. I'm sharing the particular screen, PPT. Okay. Friends, first of all, I'm talking about particular 3 clauses. Okay. This is clause number 1. I'm just giving the name that particular clause is clause number 2 and clause number 3. And my question from the house is that in case my business turnover is more than 10 CR, I'm simply assuming the fact that business turnover is more than 10 CR and I'm not a company. Okay, I'm a sole proprietor or maybe HUF or maybe partnership firm who is not required to get audited under any other law. So I'm a sole proprietor doing business. My business turnover is more than 10 CR. Now, in that particular case, which clause is required to be selected out of 1 and 3? Out of 1 and 3. Business turnover is more than 10 CR. And we have to select out of 1 or 3. And friends, there is another question which is in relation to that, that my business turnover is between 1 to 10 CR and there is a cash involvement which is more than 5%. That means audit is required. I'm not talking about 44AD at all. I'm simply assuming that there is no provision like 44AD at all. The business turnover between 1 CR to 10 CR with cash involvement more than 5%. And there is a second situation that there is business turnover more than 10 CR. Friends, that particular aspect I'm discussing because of the simple reason. Friends, the language which is used in the form 3CD is different from the language which is used in case of section 44AB. If we talk about section 44AB, that says the tax audit is required in case business turnover is more than 1 CR. Okay. And then Proviso simply says that if your business turnover is up to 10 CR and cash involvement is within 5%, cash involvement is within 5%, then tax audit is not required, or you can say that 1 crore limit need to be substituted with the limit of 10 CR. But if we talk about this particular last clause, which I have named to be clause number 3, it says proviso where aggregate cash receipts and cash payments of business exceeding, it uses the word exceeding specified limits. So friends, that means that if your business turnover is between 1 to 10 CR and still audit is required in that particular case, this particular clause need to be selected and not the first one. The first one is required to be selected only in the case when business turnover is more than 10 CR. Now I'm changing the little bit situation that the assessee is a company assessee. And obviously that company is required to go for the statutory audit under Companies Act. Now in that case, we all know that we need to go for form 3CA. Turnover is greater than 10 CR. Now the same question, which particular clause need to be selected out of clause number 1 or 2 or 3? obviously we'll say that the clause number 3 rule out because it applicable only in case of that cash involvement. So we have left with the options with the 1 or 2. Then which particular clause need to be selected? Friends, if we go by that tax audit guidance note, whether the latest one or the old one, if we talk about, in any case, it is no doubt that we need to select third proviso to section 44AB, that is audited under any other law. But friends, by selecting this particular clause, that clause number 2, are we giving the particular picture in the form 3CD that why tax audit is required? It is just a proviso selecting. We are giving the view that it is already audited under any other law. That's why we have not audited the books of accounts. Yeah, ma'am, please.
Sorry for interrupting, sir. Sir, आपकी bottom right में एक वो box आ रहा है. अगर आप उसे click करके हटा सकते हैं तो.
Ma'am, there is no box in my screen if I talk about.
अच्छा, okay.
Aha.
Yeah.
Okay. Okay, that may be some reason. I have no idea why it is coming. Yeah, it is there.
It's fine, sir.
Okay. So friends, coming to that particular aspect, in my view, that we should give a particular idea that why section 44AB is applicable. Friends, even if we go by the utility of the form 3CD, we can add the reasons why the tax audit is there. In my view, the first of all, at first aspect, we should select this one. And second, if business turnover is more than 10 CR, then it should be selected as the second option. That will give the true and fair idea that why section 44AB is applicable in this particular case. But while generating UDIN, obviously there is only one option we can select, and that will be third proviso to section 44AB and not 44ABA. So friends, add button is there. If we talk about in respect of utility, kindly take that particular case. We should select at least two options while going for form 3CA. That we have already discussed, friends. Coming to particular aspect of new regime. Friends, if we talk about that particular guidance note of 2023, a detailed guidelines have been provided in this particular guidance note that how as an auditor we should approach for this particular aspect. New tax regime. Friends, tax audit is required to be signed and uploaded by 30th of September. We all know that. But income tax return is required to be submitted in these cases by the assessee by 31st of October. Now, as per law, regarding opting of new tax regime or regarding opting of old tax regime or withdrawing from new tax to old tax, whatever, that decisions can be taken by the assessee on or before due date of ITR. But we have to certify that particular aspect on or before 30th of September. Now, how can we be sure whether assessee is going to opt that new tax regime or is already opting new tax regime, is going to withdraw that particular new tax regime or not? In individuals, it is allowed. So friends, there is only one way. First of all, we should have signed copy of Form 3CD. It is the responsibility of the assessee to fill out the Form 3CD. We should have the signed copy, a representation letter, and if particular compliance is required to be made by the assessee in the terms of Form number 10 IC or 10 IE, we should have that particular form with us. And friends, representation letter is must, because it is quite possible that the assessee may change the decision later on and he is valid and he is legally valid to change that particular option. But we have to go by the, as an auditor perspective, the aspect which has been removed. I don't know the reason, but I think they may have been the obsolete or very old definitions which are no more relevant from the perspective of the tax audit aspect. That is Guide to Company Audit issued by the Institute in the year 1980. The statement on the amendments to Schedule 6 to the Companies Act 1956 issued by the Institute, and the statement on the Company's Auditor's Report Order 2003 issued by the Institute in April 2004. But I do not think so that is going to make any impact. In the guidance note, that is a very well definition, very well examples of the what aspects are to be included in turnover or not are provided. And I'm hopeful that Ms. Parul is also going to discuss that particular aspect. And for the purpose of derivatives, future and options, they have a very good clarification which is used to create confusion among us professionals. That computation of turnover of transactions in derivatives, futures and options is only for the limited purpose of applicability of tax audit and not for any other purpose. And not for any other purpose. If, like, for example, if I talk about the ratios, clause number 40. Friends, in the ratios, we have to disclose the turnover, will that turnover be equivalent to the turnover which is computed for the purpose of determination of applicability of tax audit? No. Friends, in clause number 40, in the ratio, the turnover is required to be reported as per the books of accounts without making any impacts of income tax law or ICDS or whatever. So determining turnover for the purpose of applicability of tax audit and reporting turnover in clause number 40 are altogether two different aspects. There is no link between them. So that has been clarified in the guidance note. In case of future options, friends, options, they have clarified that net profit not to be included where premium is included, and open position at year end, turnover to be accounted for in year of squaring off, and we have not to account for the, you can say, open position at the year end. We have not to account for the, you can say, the variations on that particular open position at the year end. Delivery based settlement in derivative transactions, turnover will be equal to difference between trade price and settlement price. Transfer of underlying asset, turnover will be equal to entire sale value if held as stock in trade. Obviously, if that person is holding as capital asset, friends, it is not required to be part of turnover at all. Removed reference to responsibility of tax auditor if audit not completed by due date. Friends, I think that is implied enough, so there is no requirement to go for the express words in the guidance note. Removed reference to aspect of summon by income tax authority under section 131 to tax auditor. I think the department can give the summon that on what particular basis you have certified this particular aspect, and he can ask for the documents. Remove reference to aspect whether figures verified by CA in form 3CD be accepted by tax authorities. Friends, earlier used to be there is a paragraph that ideally the department should accept the figure certified by the chartered accountant, but if he has a proper documentation, or you can say a difference in the legal view, he can move from the view taken by the chartered accountant in form 3CD. So I think that is an established principle. I do not think so that giving that particular paragraph reference in the guidance note make any difference at all.
Excuse me, sir.
Yep, ma'am.
So please take a 1 minute and check your Wi-Fi connection because your video is also fluctuating too much.
Okay.
Yeah.
Just let me check. Just a second.
Yeah. Now this is fine. I mean, when you were sharing the PPT, your video was fluctuating.
Okay. Let me video settings. Okay, this is I do not think so any kind of problem is there. Ma'am, speed test is giving a quite good speed, that approximate 90 Mbps of downloading and uploading both.
Okay. Okay. Okay,
maybe.
Please start again.
Yeah. Friends, regarding coming to the clause 27, subclause A, SANVAT related. Friends, in the guidance note, it has been clarified in the very clear wordage that in this particular clause only, reporting requirement is there only when the assessee is dealing in the products on which still SANVAT is applicable. Like, for example, petroleum, crude, diesel, petrol, aviation, turbine fuel, natural gas, and tobacco. Friends, when SANVAT concept is there, so there is a problem. If we talk about the confusion is because of the utility language in the utility provided by the government versus language in the notified form 3CD. If we go by the utility in that particular aspect, they have used the word GST. So that gives the confusion that whether we have to go for the GST reporting or not in clause 27A. So friends, in the guidance note, it is very clear. Now, as coming to the part as an auditor, friends, we should have a signed copy of form 3CD from the assessee in which the language must be same as those of the notified form 3CD and not as that of the utility. And we should give a suitable observation, or you can say comment in the form 3C or 3CB regarding this particular aspect, that the utility is using the words GST, but it is nowhere in the notified form 3CD. That's why that the clause 27A has been reported on the basis of the applicability of SANVAT and not on the basis of the applicability of the GST. Friend, we must be clear. If we certify form 3CD as provided by the utility and without observations in form 3C or 3CB, I think we are doing a wrong. Interest payment to associated enterprises regarding applicability of 94B, limit of 1 crore. Friends, it seems that the guidance note team has a view that it is need to be seen in the aggregate for all associated enterprises, although it is a matter of dispute whether it is to seen in aggregate or for every associated enterprises separately. Now, friends, my question from the house: if there is a particular disallowance which is made by the act itself, which is required to be made by the act, and further there is that same disallowance is required to be made by virtue of ICDS also. Like the best example, if I talk about the depreciation as per books. Friends, depreciation as per books need to be disallowed by virtue of the section 32. Further, even the ICDS, if we talk about depreciation, is need to be calculated in terms of section 32 only. That is a particular amount which is debited to P&L account, but which is not allowable. Friends, in my view, that the thing is not required to be reported twice. That is the first view if I talk about. If anything which is being disallowed by the act itself, obviously the ICDS cannot come into picture for that particular aspect. ICDS need to be checked, need to be applied, need to be recompute income only after all the provisions of the act has been applied. Even it is quite possible there are various aspects which may be reported to be twice in the form 3CD. Friends, in that particular case, if the amounts are reported twice, then give us suitable observations in the form 3C or 3CB in that particular aspect, that because of the language of the requirement or language of that particular clause, it is reported twice, although the impact in the ITR should be once only and not twice. So that particular objection will help the assessee in fighting the case with the department that the same amount cannot be added twice. Friends, there is a one tax audit quality review board observation. That is a really good observation if I talk about the prepared by the TAQRB last year, that the common mistakes which we professionals are doing while going for certification of tax audit. Friends, in case of ICDS, disclosures are must whether they are having any impact over the income or not. And we professionals are lacking in making that particular disclosures, specifically in the case when there is no impact over the income at all. But disclosures are must. In case a particular ICDS is not applicable, we should specify whether it is not applicable or nil observation we should write. We should not left blank that particular column. Coming to friends, clause number 14, method of valuation. We should check out whether the method of valuation is specified only for the finished goods or for all. Friends, as per the requirement of that particular form 3CD, disclosure is required for each and every aspect of inventory, whether it is raw material or finished goods or work in progress, consumable, stock in trade, loose tools. And for every aspect that is required to be disclosed separately. Friends, TAQRB has that notice that even after writing these particular 6 types of, you can say, inventory, a single line item is written that cost or NRV is whichever is lower or whatever that inventory valuation policy is being followed. As per the requirement, we have to specify all the 6 items separately and then a comment of each and every item in inventory, the method of valuation. It may be same, it may be different. Clause 16, amounts not credited. Friends, this is one of the clause where you can say the opinion is required, a legal call or professional approach is required. Practical issues are there in case of individuals, where there is a single balance sheet and single P&L of individual, including personal incomes. Friends, generally happens that whenever the assessee visits a particular profession, he provides each and every information because he wants assistance not only in certification of 3CD, but also in preparation of computation of income also. Now, what happens as professional, we know that that particular person is earning rent income also, which is not part of business books of accounts. He might be earning interest income, which are not part of a business P&L account. And what happens that these particular incomes are reported in clause 16. In clause 16, only those incomes are required to be reported which are part of business books of accounts. Whatever personal incomes are there and not forming part of P&L account are not required to be reported at all. If that particular income is already credited to P&L account, obviously requirement is not there. But if it is not credited to P&L account but directly routed to, you can say, the balance sheet, or it may be possible that you come to a particular situation that particular income is received by the assessee in his personal accounts, and that information you have in that particular also that clause 16 reporting requirement is there. Waiver of loan. Friends, obviously the problem is going to be with effect from assessment year 24-25, because in my opinion, after the amendment of that particular section 28(4) by Finance Act 2013, it has been made clear that waiver of loan obviously taken for the business purposes will be treated as income under head business. Section 194R TDS may be there. That is quite possible. If there waiver of loans with effect from assessment year 24-25, it is taxable. Up to assessment year 23-24, I think we should give the suitable observations in form ECA 3CB in case the assessee believes it is not taxable by virtue of Honorable Supreme Court judgment. Friends, we all know that recently the Honorable Supreme Court has held that the waiver of loan, because of in money terms, it is not required to be, it is not taxable by virtue of section 28(4). Coming to this employee's contribution. Friends, we all know that this particular dispute has been ended by Finance Act 21. That for employees' contribution, due date of relevant act will be applicable, and 43B is not applicable. That is, up to due date of ITR, no benefit will be provided. And recently we have Honorable Supreme Court judgment in which held the similar thing for past years even, that for the employee's contribution, in any case, due date of the relevant act need to be seen. And we know that this particular relevant date is 15th of next month. Friends, we all know that in the past there were issues on relying on the particular Honorable High Court judgments. We used to certify that the employee's contribution, for example, it was due on 15th of, you can say, July 2022. But it was deposited in month of April 2023. So we used to have belief that this is allowable by virtue of Honorable High Court judgments. But in tax audit form, the assessee provides the information that the due date is 15th of July, deposited on April 2023, and we used to certify the same. But when assessee files the income tax return, he claims that particular employee's contribution as deduction, or you can say other way around, that it does not make any disallowance at all. Now, on the one side, there is a view in the tax audit form. What is the view? That due date is 15th of July. But when the same assessee files the income tax return, he takes the view that the due date is 31st of October of the assessment year. That the same assessee is taking two views, obviously that is not going to be acceptable. Friends, this particular aspect has relevance even as on date also. My question is that in case of salary in relation to May 2022, which was paid on 7th of June 2022, the due date for this will be 15th of June 2022 or 15th of July 2022. In other words, the due date need to be seen from the perspective of the, you can say, the month in which relation to salary is being paid, or need to be seen from the perspective of the month in which salary is actually paid. Friends, this is a disputed matter, and we have some favorable judgments of the tribunal. According to that, friends, the relevant act uses the word paid. That means the due date need to be seen from the perspective of the date on which the salary is being paid. Friends, if the due date is considered in the terms of May 2022, then in case of payment of arrears of salary, obviously there will always be delay in depositing the employee's contribution. And I do not think so that was the intendment of the lawmakers. So friends, in my knowledge, I am not able to find out any kind of adverse judgment in favor of revenue if I talk about, but there are judgments up to the tribunal level in favor of the assessee that due date need to be seen, that is 15th of July in this particular case and not 15th of June. Now, what should be the strategy while certifying Form 3CD? Friends, this particular due date is not auto-populated, but that need to be punched. And in my view, for the purpose of the salary in relation to May 2022, which is paid on 7th of June, the due date need to be filled 15th of July 2022, and that particular aspect must be provided in Form 3C or 3CB also. I think I'm clear this particular aspect. Friends, these are the documents we should obtain: the copy of the challans, list of the contributions made. We should, and obviously the employer's contribution is not particular press. Friends, section 48.3, Thales sir were discussing that particular aspect, that payment in respect of more than 10,000. Obviously, the assessee do not have such kind of documents from which we can ensure whether they have been account paid check or not. Although this particular problem is getting, you can say, the mitigated by day, because of the, you can say, the less circulation of the cash and the people having habit to make online payments. So that is a suggestive reporting by the guidance note also. We should take care of that particular aspect. TDS, question arises whether 100% of the expense is to be, whether in case of resident deductee, whether expense 100% need to be reported or 30%. That is my personal view and interpretation of the Tax Audit Quality Review Board observations, that the amount inadmissible need to be reported and not the 100% amount. That is my interpretation, friends. Contingent liability, I'm not discussing that particular aspect. Friends, fees on late filing of TDS statements. Even I had the similar view, which I can say the confirmed by the Tax Audit Quality Review Board, that this is not a penalty, and hence not required to be reported in clause 21. And when it is not penalty, obviously this is not disallowable under section 37 also. And I think this interpretation can be extended to, friends, other fees also, like ROC fees, maybe GST late fees, whatever the case may be. So wherever there is a late fees, it cannot be equated with penalty. Friends, if you have any particular question related to the clauses we are discussing, you are most welcome to ask in between also. Ma'am, what will be the basis that I will come to know the queries of the participants?
Sir, already queries हैं हमारे पास.
Okay.
Complete कर लेते हैं इसको, तो हम उसके बाद लेते हैं queries को.
ठीक है. Friends, related party transactions that I have not addressed you all the professional friends as brother and sisters. Otherwise, it will lead to my particular issues. The whole of the CA fraternity is my brother and sisters. Friends, coming to the important parts, 43B, okay, sandwich STSC that we have discussed. Friends, coming to the 56 to 10, specifically in case of, if I talk about companies SSC. Whether buyback of shares is required to be reported or not. In my view, no. The very simple reason, when 56 to 10 is applicable only in case when I receive something. In case of buyback of shares, I do not receive something. As soon as the shares are being buyback, they are extinguished at all. It cannot be said that I have received something. In my view, that buyback of shares is not covered up by 56 to 10, hence not reportable as part of that. Bonus shares, again, the settled principle that there is no accretion of income at all by issue of bonus shares. So obviously 56 to 10 does not apply at all. Right shares or fresh issue of shares, that is a disputable matter. That we have to take a professional call, specifically in case of, you can say, if the right shares or fresh issue is not proportionate. Is not proportionate. Like, for example, I am holding 20% share, but in the right shares or by virtue of the fresh shares, my shareholding increases to 25%. And it is quite possible that maybe the sum of the shareholders may not have opted for that particular right shares or they may have renounced that particular right shares in my case. Friends, in that case, my shareholding is increasing by 5%, and it may be possible, considering the fair market value of those shares in terms of Rule 11UA, I might be paying less and I'm getting more benefit. So I think that should be reported. Obviously, we will have the limited data. We do not have the access to the financials of that particular company issuing the shares. The suitable disclaimer, or you can say suitable observations, should be provided as part of Form 3CA or 3CB. Friends, coming to clause 44, straightforward. That is the most important. I think you must be waiting for all that particular aspect. Clause 44. That is reporting in respect of GST. I have heard that many professors have not particularly certified this particular clause at all last year, being the first year. Friends, whatever has been done, okay, has been done. But obviously, this clause 44 required certification from our side. Now, what all aspects required to be reported under clause 44 and which aspects are not required to be reported at all? So I have tried to summarize that particular aspect considering my limited knowledge of GST and obviously with the help of the guidance note 2023. I've tried my best and my interpretation is also there in between the same. Friends, first of all, in column number 2 that we have to provide for each and every expenditure separately, no. Although there is an option to add the rows, but that is choice of the assessee whether to report each and every expenditure separately or in a cumulative manner. It may be possible the assessee may be holding multiple GST number because of operating over the states. Again, in that case, it is the choice of the assessee whether to report in a cumulative aggregate manner or separately. So it's a choice. So it does not require any kind of professional approach. It's the choice of the assessee whether to report in aggregate or separate. Now, both revenue and capital expenditure need to be recorded because on capital expenditure also GSTs are there. GST input may be possible. Friends, considering that the capital expenditure is required to be reported, I do not think so that the column number 2 must be equal to expenditures debited in P&L account. Friends, obviously, when you are including capital expenditure, it cannot be equal to the expenditures debited to P&L account. Depreciation is just a calculation from the capital expenditure. I do not think so that the column number 2 depreciation must be provided for. But we must have kind of a reconciliation with us, starting from the total of the expenditures debited in P&L account. Then what all aspects we have adjusted while reporting under clause number 44. The first aspect, depreciation, in my opinion, it is not required to be reported in column number 2 as well as column number 3 to 7. But when we coming to the bad debts of the provisions, these are called to be non-cash charge to P&L. As such, there is no outflow in money terms or outflow in terms of any benefit to the person. In my view, when this is not a non-cash, when this is a non-cash charge, it is not required to be column number 3 to 7, but it should form part of column number 2. Now, what is the difference between this particular aspect and this particular aspect? When we talk about depreciation, friends, this is indirectly being included as part of column number 2 and even 3 to 7 because capital expenditure is forming part of that particular total expenditure. But in case of bad debts or provision, it is not so. The bad debts or provision should be provided as part of column number 2, but not as part of column number 3 to 7. But please take care, except for a provision for bad and doubtful debts. Like, for example, there may be provision for warranties. Provision for warranties. Again, it's a non-cash charge, but it is quite possible in the next year, warranties are entertained and that expenditure is debited to provision for warranties account and it is not hitting P&L account also. So next year, in my opinion, that particular actual expenditure on warranties entertained must form part of column number 2 and even 3 to 7. And even 3 to 7. That we have to take care. Anything which is not routed through P&L account in the current year, because of this particular kind of creation of provisions which have been routed through P&L in the past years, friends, need to be reported in clause 44. Because these particular expenditures involve GST also. Coming to transactions not treated as supply of services or goods. Best example, salary. Friends, in my opinion, in column number 2, it is required to be reported, but not part of column number 3 to 7. Non-GST expenditures like petroleum are called exempted supply. And in case that particular need to be reported in column number 3. Column number 3. Column 6, in my opinion, should be equal to 3 plus 4 for 5. There is a confusion with the professionals that they have used the word total payment in this particular column number 6. I do not think so that the interpretation of payment word required to be made. The column shift should be equal to 3 plus 4 plus 5, but 2 need not be equal to 6 plus 7. Generally, okay, but except for reasons mentioned above that we have discussed, like depreciation, capital expenditure, bad debts, provisions. Coming to the interest, like for example, I am doing a business of sole proprietorship and I have borrowed loans from multiple persons other than banks or NBFCs. On interest, there is no GST. I have no idea whether that particular person is registered under GST or not. Now, should I report that particular interest expense under this particular clause? Friends, I can check whether that particular person is registered or not. Through the PAN number, we all know that on the GST portal, we can check out whether that person is registered or not. If that person is registered, it's better to that report that particular interest amount as part of column number 3 and not as part of column number 7. And it is, in my personal view, that is my way of doing the tax audits. If I talk about regarding those particular expenditures which are required to be reported in clause number 7, I try to provide that breakup nomenclature of that particular expense as part of column number 2. Like best example, if I talk about interests, so that it is clear at the end of the department also, that is the interest which in many cases it is quite possible that from unregistered entities. Ma'am, we can go for the queries. I think the most maximum that clauses which are relevant in the day-to-day audits, if I talk about, I have discussed. Otherwise, there are plethora of that clauses are there.
Yeah, sure, sir, because we have a limited time.
Because I want to listen to Parul ma'am also, and I want to have that knowledge gain. Being if I talk about the Marwadi, Banya, and then chartered accountant, obviously I try to gain something, whether I am able to give something or not.
Yeah, sure, sir. Actually, it was a truly useful presentation because you have explained it clause-wise. Because ultimately, while preparing tax audit, we have to compulsorily go through these clauses. So, thank you so much, sir. So, we have many queries. Sir, am I audible to you?
Yeah, ma'am. Yeah, I'm getting your voice.
Your video is actually not working.
I'm just checking.
Yeah. So, sir, first query is, in one partnership firm, there was manufacturing activity during the previous year, 2021-22, but during the previous year, 22-23, it carried out only trading activity. So question is, can depreciation on plant and machinery be claimed for the previous year, 2022-23, even though machinery was not used during the year?
I got your point that the manufacturing business has been that stopped totally. In that particular aspect, if I talk about it, depends on the aspect. If the manufacturing aspect is stopped, or you can say that have been hold for a temporary period because of some reasons like strike of the labor, or maybe that power supply is affected, or maybe some kind of reasons. And if you have plan or you are trying to that continue the manufacturing activities in the coming year, then in my view, the depreciation is allowable because temporary hold does not restrict to the depreciation claim under the income tax law. But in case that manufacturing business has been stopped totally and those plant and machinery are not being used even for a single day during the year, then obviously you cannot claim the depreciation at all because that depreciation is not linked to your taxable business.
Okay. So
that machinery will be on the hold. Whenever you are going to sell out, obviously there will be a resulting short-term or long-term capital loss or profit, whatever the case may be.
Okay. So if there is a temporary hold, so we can claim depreciation in that case.
Ma'am. Yeah.
Okay. So next query is whether it is mandatory to show salary, depreciation, exchange fluctuation, interest, penalty amount in clause 44.
Coming to one by one, depreciation that we have already discussed. Then come to one by one that particular, the words have been used.
Another is exchange fluctuation.
Exchange fluctuation. Again, that is if we talk about the non-cash charge, I think that should form part of column number 2 and not part of column number 3 to 7. But in case in the future, if it is required to be paid in excess of the liability incurred because of the exchange fluctuation, in that case, in that particular year, it should form part of column number 3 to 7.
Okay. And what about the interest and penalty part?
Interest we have already discussed. Penalty, I think that should form part of the, you can say, column number 3 because it is kind of exempted supply.
Okay.
Yeah.
So, sir, next query is financial year 21-22 turnover was 1.25 crore and filed income tax return under section 44 AD. Financial year 22-23 turnover is rupees 3.25 crore. Whether assessee need to get compulsory audit or he can go for less 5% cash expense or receipt without tax audit up to 10 crore.
Okay, I got your point, that particular aspect, that the assessee is required to opt out of the section 44 AD by virtue of the reason that the turnover exceeds 2 crore. That means we can say that he is not opting out of 44 AD by his personal wish, but because of the applicability of the law. So in that case, my personal view is that the audit is not required, provided cash involvement is within 5%, that I'm assuming. Audit is not required up to 10 CR. The language they use, the 44 AD has used the opt-in and opt-out. When we use the word opt, that means as per the choice of the assessee. As per the choice of the assessee. When the turnover exceeds 2 crore, it is not choice of the assessee. So I do not think that audit should be applied on that particular person. In that particular case, obviously the profit margin will not matter. That is my personal view. That is a particular disclaimer that in my view, the audit is not required.
All right.
Yeah.
So next one is, sir, in case of proprietorship concern, cash drawing by proprietor for personal expenses will be included in working of 5% expenses under no tax audit scheme up to 10 crores.
Okay, I got your point. The sole proprietor you are talking about and the cash is being withdrawn.
Yeah.
I think in that particular aspect, if I talk about that will be included from the reason is that from the business perspective, we have to check out whether there is involvement 5% or not. In any case, contra entry should not be accounted for. But this is not a contra entry when we talk about.
Yeah.
When we talk about the contra entry, it means the transaction between two banks or bank or cash account. But it is not bank or cash account or bank or to bank account. It is like bank to capital or capital to bank. So in that case, in my view, that should form part of the 5% limits and accordingly need to be checked.
Okay. So next is, sir, for intraday trading, how to calculate the turnover?
I think that is very in clear terms for the applicability of tax audit. It is provided by the guidance note even that the total of the negatives and positives we need to check out. If that crosses the limit of 1 CR or 10 CR as the case may be, we should go for the tax audit. In case of options, there is a little bit confusion, which I think that resolved by the guidance note also, that in case the premium is being included, then the net profit resulting on that particular transaction need not be included.
Okay. So next one is, sir, the assessee company has turnover around 2.5 crores. They had losses in previous assessment year 2022-23 and profits in current assessment year 2023-24. They have short-term and long-term capital gains due to sale and extinguishment of block of immovable property and accounting profits due to settlement of loans and interest with the lender through the proceeding of sale of immovable property. Is tax audit compulsory in such case, knowing that turnover is less than rupees 10 crore and all the transactions are carried through banking channels?
For the purpose of tax audit, the very simple thing is that we have to check out the turnover of the business. If any transaction which is accessible as part of capital gains or accessible as part of other sources, obviously that is not forming part of turnover at all. Now coming to the turnover, obviously the ma'am is going to discuss that particular aspect. Even in the guidance note also many aspects are provided. So I think the ma'am is would be that better to give that particular opinion on the aspect of the transactions which hits the business head, whether forms part of turnover or not.
Okay. So sir, last query लेते हैं अभी हम, फिर इसके बाद मैम का start होगा and you need to stay with us for further session. Yeah. So cooperative societies are selling fertilizers, seeds, etc. to members. They prepare trading account in which sales are credited. In the profit and loss account, they also credited the water charges received from members, interest on loan given to the members, the interest received from deposit in bank. Which income is to be considered for calculating turnover for the society for the purpose of 44AB of the Income Tax Act 1961?
In that particular case, if that any particular income is not taxable because of the concept of the mutuality or some other aspect, so that is a disputable matter. Because if we talk about like regarding agricultural income, that we have the very much clarity that in any case, agricultural income does not form part of the turnover at all because it is straightforward exempt. Now it is quite possible for the cooperative society, many incomes are exempt because of the principle of mutuality. So in my view also, those incomes should not form part of the turnover. But if it comes to the cooperative society claiming deduction under section 80P, so that because of by virtue of that deduction, we cannot say that the turnover is reduced by the amounts of income. In that case, obviously the interest incomes and each and everything need to be included, which are part, again, the same thing that is part of business head. Like for example, if idle funds are invested by the cooperative society in FDs and interest is there, in my view, that is part of other sources and not part of business head. In that case, that interest would not be included as part of turnover.
Thank you so much, sir.
Thank you.
So over to you, ma'am. Please start your session. And sir, please stay with us for further question and answer session.
Yeah, ma'am, definitely.
Hello, everybody. Thank you so much for, indeed, Pankaj, it was a wonderful session. And there was much to learn, and many of the positions were affirmed by you. And it's really great that you also put light on the recent amended 2023 version of the ICI guidance that has come up. You have also, put up some light on certain matters, the additions in that revised one. So thank you so much for your contributions. Now moving on to my slide. So I'll be primarily talking about the tax audit report. And when it comes to decisions like an advisory pertaining to the applicability of the tax audit, that is what I will be deliberating upon today, be it the turnover, the interplay of presumptive taxation and tax audit, and the usage of Form 3CA and 3CB. So all those points I'll be covering, and thereby touching upon a few clauses as well if the time permits. So let's begin. So in the first slide, I've tried to articulate about the process of the tax audit, the procedure which it is. So in case of companies, when we start the audit, then we have to certify, all the whatever clauses are there, they are part of Form 3CD, which needs to be certified. So we have to do a clause by clause audit, be it an individual or be it a company. And we also place reliance on the work of the statutory auditor and the statutory auditor's report in those cases. And we generally use the work of another auditor. So there is already a standard of auditing 600, which is available to us, and we should abide by it once we are conducting the tax audit also. Talking about the threshold a little bit, sometimes there is a confusion with some of the practitioners about the quantum of the tax audit. So if it is 60 tax audits are permissible to be conducted by one member of a partnership firm or one member who is holding a COP. So then if there is a firm of chartered accountants, say there are 3 partners, then sometimes the question arises that whether one partner can sign on behalf of the entire firm. And if yes, then can one, so wouldn't it be a case of exceeding the limit of 60 tax audits which are applicable for one partner? So a very simple answer, and it is also being provided in the guidance note here, is that yes, one partner can sign on behalf of other partners also, but overall at the firm level, the number of audits should not exceed 180 in this case, the example that I was talking about. So if there is an allocation of 60 per partner and there are 3 partners, then the total number of audits should not go beyond 180. And one partner can sign on behalf of the entire firm, but they have to ensure that there are no other joint audits or any other kind of tax audits whatsoever being undertaken by that entire firm. So that is one aspect of it. So we have to be very clear once we are signing. Then we also have to be we have to also understand that as practicing chartered accountants, there should be complete independence. So for example, for a client for whom we are doing an internal audit, we cannot do the tax audit of the same client. Or if there is a client with whom we are related in any which ways, like if we have given any guarantees for a loan taken by the client, or if we are indebted to the client for more than an amount of 1 lakh rupees, then there are many other, arrangements which we enter into, or we are doing accounting for that client. Then we cannot do the tax audit because the independence gets hampered. So we have to be cognizant also of the fact that we shouldn't cross the threshold of the number of audits that are there for the CA. And we should also at all levels, we should maintain our independence. Now coming to the audit. So there are, sometimes when we say we are using the work of another auditor, it could be the statutory auditor of the company. It could be the audit under any other law. It could be an excise audit. And as Pankaj said in the last query, it could be an audit under section 80P. It could be a audit of the cooperative society, which could be done by a non-CA. So these kind of audits also, if we are using the work of another auditor and we are relying on the numbers to be accurate on the basis of that audit, then we must use Form 3CA, and we have to categorically, say that yes, we are relying on the work of another auditor. So that's another thing we have to keep in mind. And the tax auditor will have to conduct the audit by applying the generally accepted auditing procedures which are applicable in case of the audit. And that's how we have to proceed. Also, there is a specific mention in 3CA, there is a clause 3 where we can write about the qualifications or the assumptions or whatever our conclusions are, and we should put up all of that under clause 3 of form 3CA. That's a very important clause, and it should be drafted very well. Another thing which we should keep in mind is that there is also a clause 5 in form 3CB where we can give our qualifications. We can write about the assumptions that, okay, since the entire data was not available to us, so we have based our conclusion on the basis of the scope which we have got, and this is our comfort level on the sample size of the data that we got, and accordingly all those notes, they shall form part of the clause 5. So clause 3 of form 3CA and clause 5 of form 3CB are very important here. So that's how we have to report into the not just the 3CB, because that's a clause-wise reporting, but also in form 3CA and 3CB. These are very important things because we are relying on the work of another auditor in case of 3CA. And in case of 3CB, we are conducting the audit ourselves. So if there is a limitation on the data availability or there's any other kind of limitation or disqualification, then we must mention it in these respective clauses. Clause 3 of form 3CA and clause 5 of form 3CB. Now coming to this section 44AB, which says every person, while carrying on a business, if the sales turnover or gross receipts, as the case may be, in the business exceeds 1 crore. So as Pankaj ji in the last deliberation very well noted the changes in the definition of turnover under the Companies Act, we must keep that also in mind. And we have to decide, while deciding the 1 crore threshold, we have to keep all these definitions in our mind. But as a practitioner, we can choose a particular definition. So it is not that we can have our own view about this, because and two professionals, or the client and the practitioner, may have different views on the selection of the threshold of 1 crore or 2 crore or 10 crores as we will proceed. But we have to abide by the generally of the common parlance, what we generally practice as professionals, and also in light of the guidance note of the ICI. But yeah, at certain areas, my views differ, and it could be possible that views of two professionals may also differ. So wherever there is a difference of opinion, we must also account for that in the form 3CB. So if your payments, and so there is this proviso to section 44AB, as you can see, it uses the word and. So we have to look at even the expenses as well as the income. So if in both the cases, we don't have to add it up, yeah, of course, but we have to see that income, there should not be cash income of more than 5%. And in case of expenses also, they should not be cash expenses of more than 5%. This is what we have to keep in mind while while deciding the threshold of whether 1 crore or 10 crore. So there is a threshold of 1 crore. So if the taxpayer falls below 1 crore, then no tax audit is required. But if the assessee, the turnover of the assessee exceeds 1 crore, then we have to check. Then we have to take the entire, sale proceeds of that year, all the receipts actually, because the term used here is amount received, all amounts received, including the amounts received for sales and turnover or gross receipts. So out here, it is not only about gross receipts. The term used in the proviso is all amounts received and all payments made. So once our client exceeds the turnover of 1 crore, then we have to decide that whether all amounts received we have to see, and then we have to see all payments, and accordingly we have to decide the turnover. And then we have to compute the 5% of the all amounts received and 5% of the all payments made. And if that 5%, the cash payments or the cash income exceeds 5%, then we'll stick to the threshold of 1 crore. But if it is less than 5%, then the threshold automatically increases to 10 crores. More often than not, more and more, as this is a very incentivizing proviso which is being provided in the act, so that more and more taxpayers have cashless system of accounting or cashless system of operating their business, so that they can take the advantage of higher threshold of 10 crore. And as you can see, there's a huge gap from 1 crore to 10 crore. So it's a very, very viable, option even for new businesses that are coming up, and they can accordingly do their tax planning so that the threshold gets increased and the tax audit scenario can be pushed further till the time that the turnover exceeds 10 crore. So this is something that we must advise our clients so that their threshold for tax audit can be pushed. Now, up till now, whatever we have discussed, let's have a few case studies also on that, so that we have a better clarity of the concepts which are there. So there is a company by the name of ABC Private Limited, and during the financial year 22-23, their sale is 90 lakhs, and there is a GST on the sales or amounting to 16.20 lakhs. Now, the total turnover, including GST, as we can see here, is 106.2 lakhs. And if we exclude the GST, then it becomes 90 lakhs. So it becomes very important for us to analyze in this situation that what would happen. Should we include the GST or should we exclude it? So as per the guidance note and the guidance available under the revised guidance note as well, the position here relating to GST is quite clear, and which is that if GST or any other tax is included in the sale price at the time of booking of the turnover, then no adjustment should be made and this GST would be included. However, on the other hand, if that same GST or any other tax is being shown as in separate accounts and payment to the authorities debited from those accounts, then this GST shall not form part of the turnover. Accordingly, we must book these GST entries separately, so that input can be adjusted against them and so that they do not automatically become part of the turnover. Similarly, there is also a query on sale of scrap. More often than not, we see that sometimes there is a old computers or old furniture or something that is being sold, or some other kind of scrap that gets generated in the business that gets sold. So whether or not we should include that as a part of the turnover. So sale of scrap under the head miscellaneous income, even if it is shown separately, shall form part of the sales turnover. However, if it is if this scrap sale is on account of some capital asset, scrapping of some capital asset, for example, computers or furniture or the building itself, or a small portion of the building itself, then that would not be included as part of the turnover, because that's not actually relating to your P&L. That's a capital account item, and therefore that would be excluded. Same for trade discounts. So trade discounts shall be deducted from the sales, but not the commission paid, which is allowed to the third parties. Moving on, let's discuss about the speculative transactions. So speculative transactions, as it is, they mean the transaction in which there's no actual transfer of property in the goods that's getting transferred. It is just a contract for sale or purchase of a commodity or a stock or shares, which is being settled on a periodic basis, and which ultimately gets settled on the, I think, fourth Saturday of the month, all these transactions happen in close transition, the purchase and the sale. However, there is no actual delivery of the goods, or there is no actual delivery of the shares or the other, the commodity that is in hand. So since there is no actual delivery or transfer of the commodity or the scrips, therefore they become speculative in nature, because we are fixing a price in the future and and comparing it with the purchase price that is in the present moment of time. And when we sit and settle it, we look at the profit or the loss. So accordingly, the treatment of speculative transaction that generally we do in the Income Tax Act is that we aggregate both the positives. Positive is when today's purchase price is lesser than the future settlement price, then we arrive at a positive. And a negative difference is that when today's purchase price is more than the future settlement price that we decide, then it becomes a negative difference. So one may call it a profit or a loss. So the aggregate of both profits and losses, we club them together, and accordingly we arrive at the turnover for deciding the threshold for tax audit. And we do not take the actual sale and the actual purchase value. So here we are only taking the difference, which is the plus in case of a profit and minuses in case of a loss, and we aggregate all of them together. So you would have seen, or you would have been doing this kind of this kind of a calculation even in the month of July 31st, because there may be many of your clients who must be doing a lot of stock market transactions. So you would see that in case of speculative transaction, let's take an example of an intraday trading. In case of an intraday trading, what we do is that we do not take the entire sale of a particular day. What we actually take is the difference in the sale price and the purchase price in a particular day. So whatever the difference is, be it a plus or a minus, we just take that difference and accordingly we compute the threshold. So this is a very classic example, and generally, we do this calculation much before September approaches, because we have to finally decide whether our due date is 31st July or it is September 30th. So therefore, in these cases, when it's a case of individual assessees who are doing stock market transactions, particularly intraday transactions, then it falls into the category of speculative transactions. And rather than taking the full turnover, we generally take the difference of purchase price and the sale price entered during the same day. And we only take the positive or the negative differences, which is the profit or the loss, in determining the turnover of such transaction for the purpose of determining the tax audit. Let's look at the revenue recognition in case of construction contracts and the service income. So here we have to go to the ICDS, and we see that we use a POCM method, which we follow, which is percentage of completion method. This is being recommended by the ICDS. However, you would say when ICDS was launched, we had seen that if there is a toss or if there is a confusion between the ICDS and the Income Tax Act, then the provisions of the Income Tax Act prevail, because that's the actual law of the land. So therefore, in congruence with this revenue recognition principles in case of construction contracts and service contract, which is being iterated in the ICDS, there was also an amendment made into the Income Tax Act in section 43CB1, wherein it says that the profits and gains arising from a construction contract or a contract for providing services. So it talks about both the construction contract as well as the contract for providing services shall be determined on the basis of percentage of completion method. So we will apply POCM method in both these sectors in accordance with the income computation and disclosure standards notified under subsection 2 of section 145. So here, this section 43CB is the common point which connects to which diverts the Income Tax Act towards the ICDS in case of construction contracts and in case of contract for providing services. So out here, when we do our practice, what we do is we also enter into a contract for providing services. Accordingly, we should also book our expenses and our income in accordance with the POCM method, which is the percentage of completion method. So we should provide ideally the thresholds of the scope of our work in the engagement letter. And whenever we complete one threshold, accordingly, whether or not we have raised the invoice, we should book it in the books. And I would recommend that we should even start raising the invoice according to the percentage of completion method itself, wherein we very clearly and categorically show the various threshold, or we divide the work into different thresholds. And once the first threshold gets achieved, then we should raise the invoice, and at the same time we should book it in our books as well, because that is what is being recommended by both the tax standards as well as the Income Tax Act. Now let's talk about the delivery-based transaction. Now this is a normal trading transactions that we see in all businesses that we do. So where a transaction for the purchase or sale of a commodity or a stock or shares is delivery-based. So we are talking about the normal regular business transactions, which are more often than not, they are delivery-based. So all transactions which are delivery-based, whether intended or by default, then the total value of the sales is to be considered as the turnover. So in such normal business transactions where there's actual delivery is happening, then we take up the entire turnover and we do not take the difference. The difference we take only in case of speculative businesses, as we discussed in the earlier slide. Now, here is an example of Kacha Ratiya and Pakka Ratiya. We must have read about this long back in our law books when we were preparing for the CA Inter, I believe. So this is a very, commonly used terms when it comes to business. And in case of Kacha Ratiya, the turnover does not include the sales effected on behalf of the principals. That's because, as the name suggests, Kacha Ratiya. Kacha means something that's not final. That's still in the, that's still in the stages of something that's uncooked. So in this case, what the agent actually does is that they maintain a relationship of principal and agent between themselves and the other party. So the party sitting at the other side of the table are the principals, and they are only acting as commission agents. They do not maintain their own inventory. They do not book the sales as sales in their books. They book it as a commission, because actually they're only charging the commission for the sale of goods that they are entering on behalf of the principal. So therefore, there is no, again, in this case, there is no actual delivery of goods, because they never purchase the goods from the principal. They do not maintain any inventory with them, and they do not even book the entire sale in their books. So what they book in, the entry that they pass in their books is generally that of a commission income. So therefore, in this case, this becomes the treatment which we have in this case is that of a speculative business, and therefore we only take the difference when we have to compute the threshold for the tax audit. So that in this case, the turnover does not include sales effected on behalf of the principal, and only gross commission has to be considered for the purposes of section 44AB. And there is also a reference of a particular circular in this case. Similarly, for the Pakka Ratiya, as the name suggests, this one is the cooked one, or we may say this is the final, kind of a Ratiya who conducts his business on a P2P basis, on a principal to principal basis. Therefore, in this case, which is the exact opposite of the Kacha Ratiya, they end up buying the goods from their principal. They store the goods with them. They have proper inventories, and they have the ownership of that inventory, and then they go ahead and sell it on a profit margin to the outside party. So therefore, the relation between the Pakka Ratiya and the constituent principal is that of a relationship between two principals. It's a P2P business relationship, and accordingly, we have to take the entire turnover that is there in the books of the Pakka Ratiya for the purposes of computing the turnover for deciding the applicability of tax audit. Now let's take another case study. So if the total turnover during a financial year of ABC Private Limited is 9 crores, and the foreign exchange fluctuation gain is 2 crores, which is shown in the P&L as other income, whether this company is liable for tax audit. So as you can see that we have already exceeded the threshold of 1 crore here, and we are sitting at the, on the periphery of the threshold of 10 crores. And we have the turnover which is booked in the books at 9 crores, and we have a forex fluctuation gain of 2 crores. So in this situation, what would happen? If we add this 2 crores to the actual turnover, then it becomes 11 crores. So we exceed the threshold of 10 crores, and accordingly, the tax audit would become mandatory. So whether this foreign exchange fluctuation gain should be added or not. So since it's this forex, assuming that this forex gain is on account of trading transaction and on account of the day-to-day business transactions of the enterprise, maybe it's an exporter, and on their exports they have had this gain which is of operational nature. So if it is of operational nature, then we will add this up, and the threshold becomes 12 crores, and therefore tax audit would be applicable. So we need to really see that from where this forex fluctuation arrives from. So if it is operational in nature, we will add it, and accordingly tax audit shall apply. Another subset of this question is that would our answer be different if this company is a SEZ unit and it is claiming exemption under section 10AA. So as we see that in case of a SEZ, we actually claim an exemption, and not a deduction. So therefore, in this situation, my understanding is that this tax audit would not apply because it's a tax holiday company, and anyhow we will have to see it as per the provisions of section 10AA. Accordingly, it shall not apply. And then there is another extension of this case study wherein if there is a forex loss of 1.5 crores which is debited to the P&L. So as you can see, there is a contrast. At first, we had a forex gain and we added it and we recommended that, the tax audit shall apply. However, in case of forex loss, I don't think we will add or we will adjust it with this 9 crore amount because it is a foreign exchange loss and it is a P&L item. It is not an item that you automatically adjust with the turnover. So it's a P&L item, it's an expense item, and it doesn't automatically gets added to or gets deducted from the turnover. Therefore, in the third leg, this loss of 1.5 crores would not get adjusted with the 9 crore number. And accordingly, we will, the tax audit shall continue to apply because the threshold would be 11 crores. Would be 9 crore itself, and therefore we will continue to not get the tax audit done because this loss of 1.5 crores we will not adjust against the turnover of 9 crores. So let's take another case study number 3, wherein the total sales of a company during financial year 22-23 is 9 crores. And there is a loss of stock due to fire amounting to 2 crores. Now the insurance company accepted the claim and compensated by paying 1.5 crores, which is shown in the P&L as other income. Whether this company is liable to the tax audit. So as we can see, there is a sales of 9 crore which is there, and then there is a loss of stock. Now since this is a loss of stock, and stock, as we know, is part of the turnover, we show it at the credit side, at the debit side of the P&L, at the credit side of the P&L. So accordingly, if there is any loss of stock due to fire and we receive 2 crores of sum from the insurance company, then it becomes operational in nature, even though it is being received as a one-time payment. So in this case, there is a loss of stock amounting to 2 crores, but the claim that we receive from the insurance company is that of 1.5 crores. However, it is a one-time payment. Still, since it is being received, since it is operational in nature, therefore, we must add this to the 9 crores of turnover, and then our turnover becomes 10.5 crores. So accordingly, tax audit shall apply in this case. So there is another sub question which arises here, that whether our answer would be different if there is a loss of factory building amounting to 5 crores for which the insurance company pays us 3 crores. So as we discussed earlier, that we avoid adding up the compensation being received on a non-operational item or a capital item. So therefore, in the second leg of this question, we will not add 3 crores to the 9 crore number, and accordingly tax audit shall not apply. The sole reason behind it is because there is a loss of factory building here, and since it's capital in nature, therefore we will not add the amount of money received from the insurance company for this transaction. Now moving on to case study number 4, there is a total sales of 9 crores for ABC Private Limited for financial year 22-23. Apart from this, as per Form 26 AS, the TDS deducted under Section 194R is 30 lakhs. Whether ABC Private Limited is liable to tax audit or not. So it's a smart way of putting up the question, because all of us already know that 194R is a withholding tax which is applicable on companies for the perquisite value. So therefore, and the rate of the TDS here is 10%. So therefore, if the TDS is deducted on amounting to 30 lakhs, then the actual amount was 3 crores. So out here, there is a turnover of 9 crore, to which we will add this amount under, this amount, the other amount of perquisite amounting to 3 crores, and then it becomes 12 crores, which is the qualifying amount for the tax audit under the proviso to section 44AB, and accordingly, the provisions of tax audit shall apply in this case. Now we are on case study number 5 on page number 14 of our presentation, wherein there is a case where there is a company ABC Private Limited, and for the year 22-23, their sales turnover is 9 crores, and the sales proceeds of scrap arises from manufacturing is 2 crores. So what is the nature of the scrap sale? It is operational in nature. Whether ABC Private Limited is liable to the tax audit. So since this scrap sale is on account of the factory operations, therefore we are going to add this. And since 11 crores is the final turnover value, and it exceeds the threshold of 10 crores, therefore ABC Private Limited shall be liable to get its tax audit done. Whether your answer would be different if the scrap sale is arisen from the sale of old computers or e-waste? No, the answer would not be same, and tax audit would not apply, because in the second leg of this question, we are having this scrap sale on account of computers and e-waste, which anyways is capital in nature. Therefore, we are not going to club this with the actual turnover of 9 crores, and therefore tax audit shall not apply. I hope everybody is able to bear with the speed. Actually, I'm not particularly doing this as a Q&A, and I'm just, doing it as a monologue, so that in lesser amount of time, we can cover more slides and we can have better understanding of more case studies on the same subject. So therefore, I'm just having it as a monologue, and I'm myself, reading the case studies and then giving you the answers as well. So I hope that everybody is able to match up with the speed, and I'm not going too fast. If that's the case, please write yes in the comments box, so that I'm aware that my speed is not too fast.
No, ma'am. Till now, we are not getting any query regarding the speed, and according to me, also it is completely fine.
Okay, yeah. Thank you so much. Thank you for your input. So we are on case study number 6 on slide 15 of the presentation. So in this case, there is a company ABC Private Limited whose total sale during financial year 22-23 is 9 crores. Now they receive an advance of 3 crores for the supply of goods, which is subsequently terminated. And this company forfeited that money. So here is a case where there is a turnover, and then there is a 3 crore of additional income that they have from a contract which actually got terminated. So the services were never rendered, but the amount was forfeited. So what would happen in this case? So we may see that this 3 crore is in nature of an advance, and since it is a forfeited advance, therefore it is operational in nature for the supply of goods or services. So therefore we will add it to the turnover of 9 crores, and accordingly the turnover becomes 12 crores, which exceeds the qualifying limit of 10 crores. So therefore tax audit shall apply in this case. Whether our answer would be different if this advance is in relation to the transfer of capital assets and subsequently forfeited? No, our answer would not be the same, because herein, in the second leg of this query, this transfer of capital asset was involved, and therefore it was a capital asset transaction. Therefore, our threshold stays 9 crore itself, and which is below the threshold limit of 10 crores. Accordingly, tax audit shall not apply. Now let's understand the proviso number A, which says the aggregate of all amounts. So let's analyze it a bit, and then let's do a case study on this as well, on this aspect of the proviso as well. Since the proviso clause A consists of the term aggregate of all amounts received, including amounts received for sales. So as you can see, the term used here is aggregate of all amounts, including the amounts received for sales and gross receipts. So therefore, we have to at first see the aggregate of all the amounts. It means received, the amounts received from the previous year receivables. So generally we book the accounting entries on accrual basis. So for example, if there is an engagement letter we just entered into, but we have not yet started rendering the services, then we show them as receivables, in the books of accounts, because this is a money that is receivable from the client next year whenever we render the service, and accordingly we book the amount. So we show it as the receivable in the current year. So in this definition of aggregate of all amounts, it means the aggregate of all amounts which includes the amount of money received from previous year receivables. So if there were any receivables which are being booked in the last year, but the actual money in relation to those receivables is received in the current year, then we are going to include it into the while computing the turnover threshold. So it shall be counted while calculating the aggregate of all amounts received. So this is an important factor which we must keep in mind, that previous year receivables we are going to add to the aggregate while applying the proviso clause A to section 43AB. Whether loan receipts will also be included in this amount. So let's see. We'll see in the upcoming case study whether capital receipt will also be included in this amount. Let us just discuss it through the case laws. Similarly, the proviso B consists of the terms aggregate of all payments made. So whatever payments you make during the year, including amounts incurred for expenditure. It means amount paid towards previous year payables. So the definition is pretty much same here. So if there was a payable in the last year, which is paid this year, then that amount is also going to be added while computing this aggregate of payments. Shall also be counted while calculating the aggregate of all payments made. Whether the repayment of loan will also be included here, and whether the expenses incurred towards the purchase of capital asset or making an investment will also be included in this payment. Let's find out with the help of a case study. So right now we are at case study number 7 on slide number 18 of our presentation. So the turnover of Mr. A during financial year 22-23 is 7 crores, out of which the cash receipts is 70 lakhs and the receivable is 1 crore. He also gets a loan of 10 crores from the bank. So as I said, and as I read out in the previous slides, when we see the aggregate of all amounts, we generally consider the receivables which are there from the previous year. Okay, so out here, the way we will compute, we will arrive at the answer is that there is a 7 crore turnover, out of which there is a cash receipt of 70 lakh. And there is a previous year receivable of 1 crore. So, and he also takes a loan of 10 crores from the bank. So firstly, from this 7 crores, we will subtract this receivable of 1 crore. And then we are going to add this 10 crore of loan from the bank. And then we arrive at 6 plus 10, 16 crores as the aggregate value. From this 16 crores, we will compute the 5% of the 16 crores, which comes to 80 lakhs. And since our entire cash receipt is just 70 lakhs, which is less than the 5% of the total turnover, which is 80 lakhs, therefore the tax audit shall not apply in the first query. Now, whether A is eligible for proviso to section 44ABA. So the answer is no, because I'll repeat. From this 7 crore, this receivable of 1 crore we will deduct, and then we'll add to it the loan of 10 crores. Okay, since it is being received this year. So we get a number of 16 crores. Once we compute the 5% of 16 crores, it comes to be 80 lakhs. And since our cash receipts the actual cash receipts of 70 lakhs is less than 80 lakhs, which is the 5% of the total turnover, therefore the proviso shall not apply. therefore the proviso shall apply, and accordingly the threshold becomes 10 crores and the tax audit shall not apply. Yeah, I'm sorry, there's a correction here. The tax audit shall not apply, but the proviso shall apply, because our cash receipts of 70 lakhs are less than the 5% of the total receipt of the aggregate, which is 80 lakhs. Now, moving on to the next leg of the question, whether your answer would be different if the sales amount is 12 crores and the receivable is 3 crore, considering the other facts remain the same. So here, I don't think there is a need to compute, because we have already exceeded the threshold of 10 crores and the actual sale amount is 12 crore itself. Therefore, the proviso shall apply, and accordingly, tax audit shall be applicable, because even under the proviso, we don't have to actually compute the 5% or not, because even the threshold of 10 crore has been exceeded. So we exceed the threshold of 1 crore and of 10 crore as well. Therefore, we will not look at the 5% cash limit here, and tax audit shall mandatorily apply. What would be the position of law if the sales during the year is 9 crore and he received 2 crores from preceding year's receivable? So in the same question, if our sale is 9 crores and we receive 2 crores from previous year as the receivable, then our threshold becomes 9 plus 2, 11. And then there was a 10 crore loan as well. So the amount becomes 21 crores. And from this, the 5% of this 21 crores is 1 crore 5 lakh. So since the threshold is 1 crore 5 lakh and we are only having this cash receipts of 70 lakhs, therefore the proviso shall apply, and accordingly, since the 70 lakhs is less than the 5% of total receipts, therefore tax audit shall not apply in this case. I hope this case study number 7 is clear to everyone. If it is not, you may raise your queries. Okay. Now we move on to case study 8A on slide number 19, wherein the turnover of Mr. A is 7 crore, out of which the cash receipt is 32 lakhs and receivable is 1 crore. Out of the receipt of 6 crore, one debtor of 1 crore is the creditor of 50 lakhs of Mr. A, and such amount were netted off and 50 lakh paid to Mr. A by check as final payment. Okay. So 50 lakh is being paid to Mr. A by check as the final payment. And all that we have here is 6 crore of turnover. And then 50 lakh is being paid. And then there is a receipt of 32 lakhs. So what do you think would be your answer? Whether Mr. A would be eligible or not? So here what we'll do is that from this 6 crore, we'll compute the 5% of the 6 crore. And it comes to what? It comes to 32 lakhs and 50,000 rupees. Since our actual cash receipt is less than the threshold amount of 32 lakhs 50,000 rupees, therefore the proviso shall apply and the tax audit shall not apply. Because our 5%, our cash receipts are less than the 5% of the receipts. Okay, so now this is just a reiteration of the earlier case studies that we just discussed, and this is just a reiteration of it. So, so the situation may arise in case of advance received in preceding year and relating to such advance, sales is appearing in the previous year. As per the wording of the proviso, all amounts received, it includes advance money received which relates to the sales of the subsequent years, should also be counted for the test of 5% in case of receipt. Now let's move on to these 44AB subclause B. Up till now we had discussed subclause A and the proviso. Now we will discuss all the remaining 4 clauses of 44AB. So clause B says that any person who's carrying on a profession in which the gross receipts of the profession exceed 50 lakh, then the tax audit shall apply. So here, as you can see, now we have another threshold, that is for in the case of the professionals. So in case of the professionals, if your turnover does not exceed 50 lakhs, then we need not get any tax audit done, provided we offer 50% of the income to tax. However, if it exceeds 50 lakh, then we have to get the tax audit done. Moving on to clause C, wherein the person carries on business shall, if the profit and gains from business are deemed to be profit and gains of such person under 44 AE, BB, BBB, both of these are applicable to non-residents as the case may be, and has claimed his income to be lower than the profits or gains of his profession in the previous year. So there are different thresholds which are being mentioned here. And if, and I think there's a 8% and a 12% and a threshold, which are the percentages which are there. So if you offer your income to tax on those percentages, on the basis of that percentages, then tax audit shall not apply. However, if it is lower, then tax audit shall apply if your maximum, your income exceeds the maximum amount chargeable to tax. Now there is also a clause D and a clause E. These are also relating to presumptive sections. Now in clause D, we have this section 44 ADA, which again applies to profession, but only the applicable profession, not all professions, but the applicable profession. There is a long list which is given in the guidance note as well as the Income Tax Act. So you can refer to it. And if because most of us professionals, we refer to this, many of the professionals use this 44 ADA as a presumptive basis of taxation. So therefore, if we are claiming our income to be lower than the profit, so if we are claiming 44 ADA, first of all, two things should be cumulatively satisfied. Firstly, the income threshold should not exceed 50 lakh. Secondly, our profit, the profit that we offer to tax should not be less than 50% of the of whatever fee it is. So if we show our income to be lower than this threshold of 50%, then the tax audit would apply. Now coming on to clause E, subclause E of 44 AB. This again talks about business. So if a person carrying on a business shall, if the provisions of 44 AD4 are applicable in his case and his income exceeds the maximum amount which is not chargeable to tax in the previous year. So under 44 AD, if your income exceeds 2 crore, then again tax audit shall apply. So we have to, so if you would see it just like that, it may look like a little confusing, but if you read it through, then it is not at all confusing and we can very well arrive at the right conclusions. So quickly, before I sum up the discussion, let us have a little bit of discussion on the interplay of the provisions of presumptive taxation and tax audit, which is 44 AD versus 44 AB. So out here there is a proviso which says, provided that section 44 AB shall not apply to the person who declares profits and gains for the previous year in accordance with the provisions of 44 AD. So if you show your profit as 6% or 8%, depending upon the provisions of 44 AD, then tax audit shall not apply. And so there is another and here which says, and his total sales or gross revenue in the previous year does not exceed 2 crores. So you have here cumulative two provisions which are cumulatively should be satisfied. Only then you come out of the ambit of tax audit, which is firstly that the turnover should not exceed 2 crore, and secondly that whatever percentage are being prescribed, you disclose your income as per those percentages and not lower than them. If you go lower than those percentages, then the tax audit shall apply. What if the profit is not declared in accordance with the provisions of 44 AD? I think we just discussed that, so we can move ahead. Now, this is a little bit about the history of the, of this section. 44 AD. So we can skip it for now. You can have a read. It's quite a, very elaborative one. So it's self-understood. Let's talk about 4484. So what 4484 says is that where an eligible assessee declares profit for any previous year in accordance with the provisions of section 44 AD, and he declares profit of any of the 5 assessment year relevant to the previous year succeeding such previous year, not in accordance with the provisions of section 44 AD1, he shall not be eligible to claim the benefits of the provisions of section 44 AD for 5 subsequent assessment year relevant to the previous year in which profit has been declared in accordance with the section 44 AD. So in essence, what they're trying to say here is that if you opt out in a particular year, then for next 5 financial years, assessment years, you will not be able to opt in. That is, you will not be able to take the benefit of section 44 AD. So therefore, in presumptive taxation, in case of business, because 44 AD applies to business, remember, it doesn't apply to profession. Under ADA, you have the option. You can opt in and you can opt out. But in AD, if you opt out in a particular year by your choice, not by the mandate, then you cannot opt in for at least a minimum period of 5 years. Now, here is a comparison of 44 ABC, the first proviso and the second proviso. So under 44 ABC, if an assessee is carrying on a business, shall, if the profits from the business are deemed to be profit under AE, BB or BBB, and he has claimed his income to be lower than the profits so deemed to be the profits of or gains of his business, then there is a proviso. This section shall not apply if the person who declares the profit or gains of the previous year in accordance with 44 AD1 and his total sales does not exceed 2 crores in the previous year. Then there is a proviso 2, which says that this section shall not apply to the person who derives the income of the nature referred to in section 44 BBA. Firstly, they have given a relief to the assessee of 44 BBA through the proviso number 2. Secondly, what they're saying is that if your threshold does not exceed 2 crores, then also the provisions of tax audit shall not apply. So for the purposes of 44 AB, these twin conditions should be satisfied. Now talking about the specified date, this is very much part of the, the specified date as are being prescribed under the Income Tax Act. So when we get our accounts audited, then the specified date in relation to an assessee is the previous year relevant to the assessment year, which means the date 1 month prior to the due date of filing of the return. So since in this case, our due date is 31st of October, therefore the specified date becomes September 30th. There's a penalty clause also, which is there for the non-filing of tax audit report, which I have not formed part of this presentation, but as a regular thing, we should know it is either 0.5% of the turnover or 1.5 lakhs, whichever is lower. So we have to be, though this section we do not use, but we should know these penalties, and we should be aware of this. Then there is an amendment in 2016 about this. This is a little bit 44AD4. This is the last slide that I may discuss in today's session, and then we can go and start taking the queries. So there is also a restriction that the taxpayer couldn't opt for the presumptive. You remember that there is a restriction. If you opt out, then for 4 years you cannot get in. But there is another extension to it which says that if because of any other reason he cannot opt for a presumptive income scheme. So here the term used is he cannot opt because of the presumptive income scheme due to any other reason, then the restriction of 44AD4 shall not apply. So the restriction that we talked about 44AD4 was that if we opt out, then for 4 years we cannot take that up. We cannot take up the benefit of 44AD. However, if there is if the presumptive income scheme does not apply because of some natural reason, then, and if there's a break because of that, then in the next year, 44AD4, we can still apply. Let's try to understand this with the help of an example, which is case study 8B. In financial year 18-19, the turnover of a company is 1.5 crore. Now, this company declares its income of 12 lakhs and opts for a presumptive income scheme under section 44AD. Okay. Now, the turnover of this company for 1920 is 2.1 crores. And for financial year 2021, INR 1.9 crores. Is it possible to opt for section 44AD in 2021? So here, primarily what is happening is that firstly, there was an income of 1.5 crore, which is less than 2 crore also, and assuming that they opted. They opted for it because they declared the income of 12 lakhs and accordingly they opted for the presumptive scheme. However, in the very next year, their turnover became 2.1 crore. So now they cannot apply 44AD. Why? Because the turnover already has exceeded. Okay, so mandatorily they cannot apply by the law. So it is not something that is in the control of the taxpayer. It is beyond the control of the taxpayer. They cannot apply. And in the next year, the turnover again falls to 1.9, which is below 2 crores. So whether in this case 44AD can be applied? Now the answer to this question is yes, it can be applied because of this extension of 44AD4, which says if because of any other reason he cannot opt for a presumptive income scheme, then the restriction of 44AD4 does not apply. So the restriction would be lifted and you can again take the benefit of 44AD, and this restriction under 44AD4 shall not apply. So again, so you will not be mandatorily opted out for the period of 5 years. So with this, I rest my case, and even though we have very limited time on this thing, but still, if there are any queries, we can take that up now.
Yeah, sure, ma'am. Now, I must say that there would not be any doubt in the participants' mind regarding the calculation of turnover for the purposes of tax audit. You have explained it so well. Such an informative session it was. Thank you so much, Parul ma'am. Yeah. So, Pankaj sir and Parul ma'am, on a brighter side, I would like to draw your attention towards the viewers, or we must say the participants of this webinar, which are more than 700. So, which is a very good number, and congratulations to both of you.
Thank you.
So now, yeah. So now we'll move forward towards the queries which were left. So, the waiver of loan for acquisition of immovable property, will that be treated as a business loan and treated as income as per amended section 28?
Yeah. So out here, as per amended section 28 also, since this was on account, so as I was explaining in the presentation, that because this is on account of capital, this transaction is a capital transaction. So even if there is a forfeiture, we would not, add this up for the purposes of deciding the turnover, and accordingly the tax audit limit, while calculating the tax audit limit, we should not add it up. So Pankaj, do you have another view on this?
Yeah, Parul, that in respect of turnover, I totally agree with your particular view. And in respect of 28 section 4, if I talk about if that particular immovable property has been acquired for the purpose of the business, then in my particular view that it will be taxable with effect from 1st of April 2023 as part of section 28.4. If that particular immovable property is acquired not part of business but for investment purposes, then that is a disputed issue whether section 56 to 10 will apply or not. In any case, I do not think so that is going to reduce the cost of the property, but 56 to 10 may be debated to be applied because you are getting benefit in terms of non-repayment of the loan. That is quite possible.
Yes. So I concur with Pankaj's view, because he was telling as per the disclosure when we do the 5610 disclosure in the clauses, and what I was talking about was for the threshold. So in the threshold, I think we both of us maintain the same position, right, Pankaj? But in terms of disclosure, when you have to disclose it in the clauses, then you have to bring this point up, and accordingly you have to make suitable disclosure as to what you are basing your opinion on.
All right. Sir, next query is for you. Participant has written, Pankaj sir, you are right that the due date of PF should be calculated from the date of payment of salary. But what if the salaries are paid late in staggered manner, spread 1 to 2 months late based on availability of the funds in the new startup IT company? In such case, how should this be dealt with?
Okay. In my particular view, that for every payment of salary, we need to check out the PF deduction. And to be on the conservative side, I will say that in case you go for the PF deduction on a particular date, that obviously the PF deduction could be on the date of payment only. But it is quite possible that you are making payment of salary first part in the month of May, then second part in the month of June, and the third part in the month of July. But salary in relation to April only. Now, if you are deducting PF contributions on proportionate basis over the 3 years, I think due date will be separate for each and every deduction. But if you are deducting PF contribution in the month of May itself, and accordingly you are maintaining the books of accounts, I think in that particular case, the due date would be like 15th of June in that particular case, because you have deducted PF in May itself.
Okay. So next one is, a professional doctor is getting remuneration and interest on capital of rupees 50 lakhs in addition to his own professional income of rupees 10 lakh. He has not opted for 44 ADA. Whether the tax audit is applicable in this case?
Yeah, could you please go back on the thresholds? From the sale of medicine, what was it? From the sale.
मैं एक बार और पढ़ देती हूँ मैम इसको. A professional doctor is getting remuneration and interest on capital of rupees 50 lakh in addition to his own professional income of rupees 10 lakh. And he has not opted for 44 ADA.
Yeah. So whether this entire 60 lakh would be taken into consideration, that's the query, right?
Yeah.
Okay. Yes. So out here, since they have not taken the 44, this ADA section, the presumptive taxation section, so therefore the entire income would be subject to the tax audit, as well as would be subject to the maintenance of the books.
Okay. So it is the second last. Whether interest on partners' capital and remuneration to working partners is to be reported in clause 44, though it is share of profit but allowed as expenditure.
Friend, in my particular view, that should be reported as part of clause number 2, because this is expenditure on the basis of the books of accounts. If you talk about, first of all, clause 44 need to be reported on the basis of the books of accounts, not from the perspective of whether a particular expenditure is allowable or disallowable as per income tax law. From the perspective of, if we talk about the books of accounts, whatever the interest or salary is being paid to the partners is business expense. But that should form part of the column number 2. But I do not think so that GST is applicable. My knowledge is limited in that particular aspect. So I think it should form part of column number 3 in my particular view, because this is kind of exempted supply, which is not leviable to GST.
Okay. So in next query, participant want to check the condition of 5%. Condition of 5% check. When turnover increases 2 crore to 10 crore, or when turnover above 1 crore but below 2 crore.
Yeah, so this 5%, so allow me to answer this. So this 5%, so there is no turnover of 2 crores in between. So it is actually 10 crores. And because for 5%, you have to only test it once, which is, if you exceed if you're below 1 crore, okay, there is no tax audit whatsoever, right? So the question doesn't arise of a tax audit. But if it is more than 1 crore, but less than 10 crore. So if it exceeds, the turnover is exceeding 10 crore, maybe it's 11 crore, 12 crore, then also the 5% doesn't, the question of testing the 5% limit doesn't arise. So the question of testing the 5% limit arises when the turnover is between 1 crore and 10 crore. Okay. So once it is between 1 crore and 10 crore, then we have to test this 5%. We take all the income and we see that, as we just discussed, that we take aggregate of all sums of income and aggregate of all sums of expenditure, and we basically just take the total amount and we do a 5% of it. And accordingly, we arrive at the number. So that let's not confuse it with another threshold of 2 crore. Let's have the range between 1 crore and 10 crore.
All right. So one last query. Participant has written, good session. One important query is that there is proprietorship concern having turnover exceeding rupees crore. He has not written the number actually. Exceeding rupees 1 crore if we assume. Is proprietorship concern required to obtain TAN and start TDS, the withholding taxes compliances? What about in case of professionals who fall in audit with turnover exceeding rupees 50 lakhs? Please share your expert advice. Sorry.
In my view, if we are doing profession, like for example, if I'm talking about me and I'm doing my profession in my individual capacity and my preceding year professional receipts were more than 50 lakh, then in current year, I need to deduct TDS under the respective sections, which are like 194 capital A or 193. If I talk about 193, obviously would not be applicable. 194C, 194H, 194I and J. Because that law is very clear. If your business carrying on the business and preceding year turnover is more than 1 CR, or if you are carrying on profession and your professional receipts are more than 50 lakh in the preceding financial year, then we need to deduct TDS in the current financial year. It is irrespective of the fact whether I opted for a presumptive taxation scheme or not. So for professionals, the TDS requirement is there if the preceding financial year receipts are more than 50 lakhs.
All right, sir and ma'am, we have entertained all the queries. Thank you so much. It was such a fruitful session. Thank you so much once again.
Thank you, Rashi, and thanks the Tax Quality Review Board for this particular opportunity. Thank you, ma'am. Thank you, Parul ma'am, also.
Thank you. Thanks a lot.
Okay.